Greetings. On behalf of the Busch School of Business and the Catholic University of America, I would like to thank you, Chairman Giancarlo, for joining us this morning for a conversation about the ethics of the financial markets and derivatives. As an Associate Dean at the Busch School, and together with President John Garvey, Dean Bowman, and John Arej, our area head in finance, I want to extend to you a warm and hearty welcome to our campus. This event takes place on the morning of the funeral for the nation's late president, the 41st President of the United States, George Herbert Walker Bush, and on a day which President Trump has declared to be a national day of mourning. Therefore, I would like to invite everyone who is with us this morning, both those present and those watching the live stream on the internet, to join me now in a brief moment of silence to show respect and to offer our prayers. And now let us say together those tender words of prayer for a departed soul, so dear to us in the Catholic tradition. Eternal rest grant unto him, O Lord.
Light shine upon him.
And may the souls of all the faithful departed through the mercy of God rest in peace.
Amen.
This remembrance of President Bush and all the faithful departed draws our attention to a striking truth about the Busch School of Business, namely that as a business school embedded in the Catholic University of America, it has a twofold orientation, unique among business schools. First, to the fullness of the truth about God, the human person, and society, avoiding all reductionisms. And second, to the distinctive contribution of the American experience to the world's understanding of entrepreneurship, free enterprise, wealth creation, the sovereignty of law, and the importance of civil society and moral restraint for any economy. The Busch School has often described its mission as educating leaders in the practice of business as a force for good through the application of Catholic social thought. We were therefore delighted when we found in the Vatican's Bollettino last May on the ethics of the financial markets the following paragraph. Quote, "It is particularly desirable that institutions such as business schools both foresee and provide as a fundamental and not merely supplementary element of their curricula of studies, a formational dimension that educates the students to understand economics and finance in the light of a vision of the totality of the human person and avoids a reductionism that sees only some dimensions of the person. And ethics is needed to design such formation. The social doctrine of the Church would be a considerable help in this connection." Unquote. These sentences describe well the mission which the Busch School has been following since its founding 6 years ago. To carry out this mission even better, we have recently instituted as one of our core areas of investigation, on a par with the usual business disciplines of finance, management, marketing, and accounting, a new area which we are calling social research, which is concerned precisely with examining Catholic social thought in relation to business and economics. Chairman Christopher "Chris" Giancarlo fittingly joins us this morning to discuss some aspects of that Vatican document in what will be for us the first of a series of 3 events on that theme. Mr. Giancarlo was unanimously confirmed to serve as chairman of the U.S. Commodity Futures Trading Commission, the CFTC, by the U.S. Senate on August 3rd of last year. Prior to becoming chairman, he had served as CFTC commissioner since his swearing in on June 16, 2014, after another unanimous Senate vote. He was nominated by President Obama on August 1st, 2013. Before entering public service, Mr. Giancarlo served as the Executive Vice President of GFI Group, Inc., a financial services firm. Prior to joining GFI, Mr. Giancarlo was Executive Vice President and U.S. Legal Counsel of Phoenix Software and was a corporate partner in the New York law firm of Brown, Raceman, Milstein, Felder, and Steiner. Mr. Giancarlo joined Brown Raceman from Giancarlo and Gleiberman, a law practice founded by Mr. Giancarlo in 1992 following his return from several years in London with the international law firm of Curtis, Mallet Prevost, Colt, and Mossel. Mr. Giancarlo was also a founding co-editor-in-chief of E-Securities, Trading and Regulation on the Internet. Mr. Giancarlo was born in Jersey City, New Jersey. He attended Skidmore College in Saratoga Springs, New York, where he graduated Phi Beta Kappa with Government Department honors. He received his law degree from the Vanderbilt University School of Law, where he was an associate research editor at the Vanderbilt Journal of Transnational Law and president of the law school's International Law Society. He has been a member of the Bar of the State of New York since 1985. Please join me in welcoming Chairman Giancarlo.
Well, thank you all very much. It's really it's an honor and it's a privilege to be here at the Busch School, and it's just wonderful to be on a college campus, to be with all of you. So thank you very much for that warm welcome, and thank you for this opportunity. So I'll turn to the Bulletino in a second, but what I wanted to do is just to establish what I thought qualified me to respond to the Vatican. And there's two criteria that we note very early on in the letter. Is one, that I'm a Catholic, practicing Catholic, and two, that I'm chair of the world's only derivatives-only regulatory body. No other country in the world divides regulation between derivatives and capital formation markets, and I'll turn to that in a second. But so let me give you a little bit of my background, and then I'll turn to the letter, and then we'll do some questions and answers. So I was educated, my elementary school education, by the Sisters of Charity in Bergen County, New Jersey. And the faith formation that I had in those very early years have stayed with me all my life, and I've practiced my faith faithfully. I try to practice my faith faithfully, both in my private life and my public life. I didn't attend Catholic high school, college, or professional school. I attended non-denominational school, but my Catholic faith, as I said, stayed with me. I went to practice law on Wall Street and practiced law both in New York and London for 16 years before a client of mine approached me about joining in a what was almost a startup company that was building trading platforms for something called credit default swaps. And I had no idea what they were. But I knew how to raise private equity and take companies public, and that's what this company was looking to do. And so in 2000, I joined the firm, and we eventually built trading platforms all over the world, basically electronic and human networks for trading things that didn't trade on exchanges. So as business school students, you know there are exchange-traded instruments, but there are also things that trade over the counter. And we built the over-the-counter networks for some of the world's largest derivative products. And so let me just take a moment and define over-the-counter and define, more importantly, derivatives. The markets that you're all probably quite familiar with are our capital formation markets. Basically, the world of capital formation are divided between two major instruments, equities, which trade on listed exchanges, and debt instruments, which for the most part trade over the counter. And that dichotomy also exists in derivatives. Now, what are derivatives? Well, capital formation instruments like stocks and bonds are what's used to assemble capital for an enterprise. So someone has an idea but no capital, needs to meet someone who has capital but no particularly really great place to put the capital in order to earn a return. And those people can meet on an exchange capital for a stake in an enterprise, or in the over-the-counter market, exchange that capital for a debt instrument, for a return, fixed income, or other return on the enterprise. That's a capital formation market, and in the US world, that is overseen by the Securities Exchange Commission. Now, there's a whole different market that's not about capital formation. It's about risk transfer and risk hedging. Someone has an enterprise, and they have risk in the enterprise. And some of that risk they may be willing to bear, but some of that risk they'd much rather transfer to someone who's better positioned to take that risk. And we have these markets in agricultural products, we have them in precious metals, we have them in currencies, we have them in interest rates, we have them in energy. You think about an enterprise that's in the business of making tractors. They're willing to take the risk that there might not be enough buyers for the tractors, and they'll use advertising and other means of finding the buyers. But they're not set up to take the risk of moving interest rates, of changing currencies. Those are things that they have no control on. And there may be better enterprises in the world, like banks or insurance companies, that might be better positioned to absorb the risk of moving interest rates, of changing currency rates. And so the derivative market exists for enterprises that have a range of risks. It could be fuel costs, it could be fluctuating agricultural prices, and it could be, as I said, interest rates or currency rates. The market exists. And the CFTC is set up, that is our agency, to oversee the markets for these. Now, where they're most well known is in agricultural products. Anybody who's seen the movie Trading Places knows about orange juice futures. Those trade in our markets. Those are the price of orange juice moving up and down, being able to trade in and out of that risk. Chicago Mercantile Exchange is a derivatives exchange for a whole range of products overseen by our agency. And I'll come back to these markets in a second when I address the Bolletino, but I just wanted you to have a basic understanding of the difference between capital formation markets overseen by the SEC, risk hedging markets, risk transfer markets overseen by the CFTC, which are in notional amounts the world's largest markets, much larger than the world overseen by the SEC. But the SEC affects our 401k, and that's why we hear about it all the time. Most of us are not trading in and out of oil products, so you're less familiar. Our markets are wholesale for the most part, but they are enormous, measured in the hundreds of trillions of dollars in notional amount. On some estimates, the markets we oversee at the CFTC are probably about 10 times the size of the markets overseen by the SEC. But they're, for the most part, wholesale, not retail. Anyway, in 2000, I left law practice and I went and joined this firm, the GFI Group, and we built these trading platforms all over the world for trading these really new instruments called credit default swaps. We took the company public in 2005. We had a very successful secondary offering in 2006. And in 2008, we were the largest trading platform for credit default swaps. So talk about, the analogy is being a surfer riding the largest wave when the tidal wave comes in, the tidal wave of the financial crisis. We were right in the center of it. And when Congress took up consideration of the Dodd-Frank Act, I was not only head of corporate development at GFI, but I was also the president of our trade association. I found myself testifying numerous times in front of Congress as to how the market worked. And unlike the banks, as the trading platform, we were seen as neutral in the issue. You know, when the stock market falls 700 points, you might blame a lot of people, but you don't blame the New York Stock Exchange. Similarly, when there was a crisis in the derivative markets, we as the platform, we were not a trading firm, we operated trading platforms, found ourselves as the one authoritative voice of how this market worked. And I wound up recommending the changes in Dodd-Frank and publicly commending President Obama and the Congress for those changes. And in 2013, when the CFTC, like the SEC, is a bipartisan commission, there's both Republicans and Democrats, When a Republican seat opened up in 2013, the Obama administration reached out to me to fill that as someone who had publicly called and supported the Dodd-Frank Act. And I was confirmed in 2014. Nobody knew me then, so I was unanimously confirmed. And to my great surprise and delight, I was renominated by President Trump to serve as the commission's chairman. And to my shock, I was again unanimously confirmed in 2017. So people still don't know me, or I'm not annoying enough people. So one or the other. I now serve as chairman of the agency, which brings me to the Bollettino. When the Vatican put forward the Bollettino in May of this year, I read it with great interest. Interestingly, it's a lengthy document and covers all manner of modern finance, a whole range of things that we at the CFTC have no authority or jurisdiction over, things that were very interesting in terms of modern finance and some of my experience on Wall Street, but not within our jurisdiction. There's only about 5 paragraphs that actually cover derivatives, and there's one paragraph that specifically refers to credit default swaps. So I found that with great interest. I also found it interesting that the press didn't cover the rest of it. They only covered the part about derivatives, which was my first compulsion to respond. But my second compulsion was that reading the Bollettino in its entirety, it really made the point that what the Vatican was looking for was to engage in a dialogue. That was what came through, that this was not the last word on a topic. This was a beginning word, and what the Vatican was saying is, it's something we ought to have a conversation on. And it did something else that I really liked. It said that faith has a role to play in dialogue on modern issues, even issues that are not related to theology. And in my public life, I've always been disappointed when public spokesmen would want to relegate faith to a really distant corner of our public dialogue, and that's just having to do with matters of faith. I think faith should inform all of our interactions, and so I was pleased and consulted with my parish priest, who really encouraged a response that it not only addressed the specific points, but acknowledged the role of faith in the public square in all our interactions, including in modern finance. So with that in mind, I talked with our chief economist, Bruce Tuckman, who's not Catholic, who's Jewish, and I said, Bruce, would you like to work with me in responding to the specific issues having to do with derivatives? And he right away said, I'd love to, and perhaps I might even get to use my Italian. And I said, you speak Italian? He is quite a Renaissance man, and I just learned something new about him in this process. But I said, fine, Bruce, but we're not going to try to respond in Italian. We'll respond in English. And so we did, and we set out to write a very respectful letter, one that acknowledged the Vatican's right and duty to address issues of modern finance, but to also correct what we thought were quite narrow, and I don't mean this in a pejorative way, but unsophisticated views on a number of issues. And perhaps maybe in the question and answer I'll get into what those are. But that was our purpose in responding, and I'll also talk a little bit about the response we've had. But we're quite pleased, and it's opened up a dialogue, which is exactly what I think it was meant to do. So with that.
That's great. So our idea here is that now the chairman and I will have a little bit of a discussion back and forth, and after that we'll open it up to questions from the floor. So first of all, I want to make an observation more than a question, which is that the title of the Vatican document is Questiones, and it's usually translated considerations, but it's very clear there in the Latin title that it's raising questions for dialogue, just as the chairman had said. So that's a very, very important point. So what would you, Chairman Giancarlo, I wonder if we could turn directly to this paragraph on credit swaps.
Yep.
So there seemed to be the argument there that they're intrinsically wrong.
Yep.
So how would you explain their argument? Does it have any kind of plausibility to you? Do you think it applies in some areas, not to some areas, to some instruments, not other instruments? And what was the general nature of your response to that part of the Bollettino?
So, again, out of respect, what we didn't want to do is challenge moral notions of intrinsically wrong, morally unacceptable. Those qualitative judgments, I thought, was not our place to make. What we wanted to do was, correct may sound arrogant, but to counter and put forward a market-based apologia, a basis for why these products exist and what they're meant to do.
But market-based looking towards a common good also.
But market-based looking toward it, so how they serve the market. So very early on, we talk about how derivatives serve the common good before even getting into credit default swaps. And there should be no doubt about the fact, if derivatives were to disappear tomorrow, the price shocks that would reverberate around the globe in food and fuel would hurt the very people that this papacy has reinforced the church's commitment to, and that is the world's poorest.
Can you explain that?
Yes, yeah. So when you have these risk transfer markets, what is the benefit of them? The benefit of them is to bring a degree of price stability to markets that are inherently unstable because of weather. Agricultural markets throughout history are unstable markets. When there's a good harvest, just basic economics, what happens to price? It goes down. An extraordinarily good harvest is almost the worst thing that can happen to growers. Because there's a huge glut and surplus. The price collapses. And in a bad harvest, you have starvation as well. So the amazing thing about agriculture is the best in times and the worst in times are the worst of times. And the reason why we never think about that in the West, the reason why when we walk in our supermarkets, we never stop for saying, wow, I wonder if it was a good summer on the American farm and if there's going to be fresh fruit and vegetables. We never do that. We just walk in and there's fresh fruit and vegetables. It's because we have functioning derivative markets. And the reason you know that is because if you've ever visited the least developed countries of the world, you know if it's a bad harvest, there'll be no food in the markets. And worse, there'll be no food the next year because the growers will have gone bankrupt by that bad harvest. And similarly, if they have a bumper crop, the price collapses and they won't be able to put seed in the ground the following year because they won't have money to buy a plow or to buy grain seed. So the fluctuation in agricultural production that has existed throughout history and still exists today in most of the world, and exists in America too, but it's offset by highly functioning derivative markets where those producers, see, everybody has price risk in the agricultural system. The growers, the producers, but also the ones that buy the produce to bake, that buy wheat to bake, that buy other agricultural products. They all have price risk. They don't know where the price will be. So I'll give you a quick example of why our markets work the way it works so well. I was in the cab, the tractor of an American farmer on his farm about a year ago. It was springtime. He was planting. And as he was driving, I know we shouldn't do this on a highway, but in a farm field, it's okay, with one hand on the wheel, he's got his iPhone out, and he's checking the prices that day for the wheat that he's not going to harvest until September or October. But because our commodities exchanges offer a price today, he could check that price. It's a futures price. It's a price that if you sold today, you would get today for a crop that's not going to be delivered to September. He then called Port Elizabeth in New Jersey and a shipper. He says, can I contract with you now for half my production that'll come up with September? And they made him a price, and that price is now contractually bound. Half his risk is taken care of, half of his price risk. So if come September, it's the greatest harvest on record and the price collapses, he's already forward sold half his production at a price today. And what price is that he's looking to get today? He's looking to cover up most of his costs. So follow me now. He knows his cost of production. Let's say his cost of production is 8 cents a bushel. And his worry is that in September, he'll get 8 cents or more per bushel, right? So that's his cost, and everything above that would be his profit. So he's locking in part of those costs today, and if the price is above that, that's more profit. But if the price is below it, he won't go bankrupt because he's covered some of his costs now. And that's what you're able to do in the futures market. You're able, if you're a farmer that knows your cost, you can pre-sell some of that production and give yourself some certainty. And that's why our family farms can go 4, 5, 6, 7 generations and remain in business and not go bankrupt. More importantly, that's why they can buy the tractor they're going to need for the next 5 years, and that's why they can hire hands. And that's why we have stability in our farming production. That's why we have stability in agriculture. And that's why all of you can go in the supermarket and not ask whether it was a good harvest, because there's stability there in agriculture. Now, it's not just agriculture. Let's talk about student loans. I mean, you can borrow at a fixed rate of interest. Some of you that own homes, you use a home ownership tool that exists virtually nowhere else in the world. It's called a 30-year fixed rate mortgage. It exists in this country as our standard home ownership tool. Now, don't tell me interest rates are staying stable for 30 years. They are going up and down those 30 years. And yet your bank, your lender, can give you a 30-rate fixed-rate mortgage because they can then go into these markets. And those are the CDS markets. Those are the credit default swap markets. And hedge the changing price of interest rates or the risk of a bank failure for 30 years in order to offer retail investors that stability. And whether it's school loans, whether it's car loans, whether it's home ownership loans, whether it's the cost of winter heat, derivatives provide stability to all of these commodities, all of these tools of ownership, tools of financing that we use. The derivative market is this subtle market that exists that provides stability to all our lives. And while the 401k is important, and that's why everybody focuses on the SEC, these derivative markets are far more basic and far more spread out in all of our lives than we know about. And they provide stability. And so when you go from the developed world where these markets are functioning and work well and the stability that exists to the least development part of the world where they don't exist, you really see the difference. There was a very good piece in the Financial Times about the vanilla market in Madagascar, and we cited it in the bulletin, in our response to the bulletin. The fluctuating price of vanilla beans in Madagascar is the difference between abject poverty and boomlet, almost millionaires, and criminal gangs come and go, depending on where the price is, all because of the lack of a functioning futures crop. So can I turn to your question? So with a little bit of background, the credit default swaps market is a way of hedging the ability of an institution to pay on their debt. I do need to do one more background thing. In addition to providing the stability, these markets also provide the price function. That farmer whose truck I was in, who checked the price on the Chicago Mercantile Exchange for his wheat in order to negotiate a price with a shipper, was using the price discovery function of the market. So let me give you an example. Cattle are sold in cash markets all over the country. And in those markets, they're auctioned. But there is no one way of establishing what the price of cattle is. It's in the cattle futures market that the price is established. Similarly, wheat is sold in individual negotiated transactions all over the country. The price is actually established in the derivative market and then applied to those cash transactions. The same thing happens in the credit default swaps market. That's where the price by which people are willing to take the risk on the default of a lender is established. So, if you're looking at the viability of a regional bank, Mike, give me a regional bank from America. KeyBank. If you're going to extend credit to KeyBank and you want to know whether KeyBank is going to be able to pay that, and therefore what type of interest you're going to charge on that loan, that credit quality of KeyBank is established in the credit default swap marketplace. And it's the major indice that we use to establish the credit quality of a lender. And it's critically important because that's where interest rates are going to be set off a benchmark rate, which would be US Treasury or LIBOR. So you use the benchmark rate, and then you establish a premium you pay based upon the creditworthiness of an institution. The credit default swap market is the reason why we have a global lending system, so you can establish the credit quality. So what we tried to establish in our letter back is the notion that these things are complicated and therefore we need to wave a magic wand and either minimize them would undermine some of the core elements. And so what we tried to do in our letter is really go back against three concepts that underlie the Vatican's concerns. And the three of them are that they saw there were three things that are bad in the marketplace. One is information asymmetry. The second one is speculation. And the third one was and this goes to the issue of credit default swaps, whether you can take advantage of the misfortune of others and whether that's legitimate in the market. And that's probably the hardest one to address, so let me come to that one last. The notion of information asymmetry. If you have better information than another person in the market, not ill-gotten information through, say, insider trading, but just say better information, whether you should be able to use that in the marketplace. In the case of credit default swaps, there are parties believing that that credit institution is not as good as the market says it is, and maybe they've done research to get to that judgment. Should they be able to exercise that? And we address that point by trying to use a little humor. There's an old joke about a person who goes to see their mechanic because the car's not working. The mechanic opens the hood of the car, looks around, studies it carefully, gets a wrench, and after a few more minutes, bangs in one certain spot, and then says, okay, go ahead and start the car. They start the car, and the car starts right up. And the person said, you did that with one bang? And the mechanic says, yes, and that'll be $100. And he says, $100 for one bang? He said, no, it's not $100 for a bang. It's $5 for the bang. It's $95 for knowing where to bang. And the notion is that in all walks of life, you have information asymmetry. Many of you are business school students. When you leave here, you're going to have information that you paid dearly for. You studied hard. You paid tuition. You may have taken out loans. You've got information about how markets work that other people in the markets won't have. Should you be able to use that in your business careers? Doctors and lawyers have skilled training. They bring that information to bear when they go into the marketplace. And there are market participants that specialize in an area of the markets and do deep analysis and understanding. Should they be able to use that in the marketplace? In fact, one would argue that the marketplace is better for that information asymmetry. And then I'll come to let me talk about speculation, and then I want to talk a little bit more about credit default swaps and that notion of using that specialized information and maybe taking advantage of the misfortune of others. But first, let me address speculation, because the Vatican talks about speculation in moral terms as being, at least in certain cases, improper. Without speculation, there wouldn't be markets. Speculators allow natural hedgers to meet, but across time. So let me explain what I mean by that. And I'll use a very simple example. A wheat grower harvests his wheat on a weekend, and on Monday drives his tractor full of wheat into town, hoping to sell that grain to a miller. He arrives with the grain, he goes to the city center, and there's no miller. What does that grower do? Turn around and go back to the farm. Now, on Tuesday, the miller shows up in town, and he or she is looking to buy grain, and there's no grower there to sell the grain because the grower went back home. Now the miller leaves the city square, his needs are not served, and more importantly, society's needs are not served because bread's not being baked, grain's not being milled. Now let's take that same scenario and say that the grower arrives in town on Monday, and although there's not a miller there, there's a speculator. And the speculator says, I'll buy your grain. I'll take the risk that the miller will show up tomorrow, or Wednesday, or Thursday, or Friday, or next week. I'll take that risk. I'm not going to pay you everything you want for your grain because I'm taking that risk, but I'll pay you something. I'll pay you something that makes it worthwhile for you not to drive back to the farm and try to come back again tomorrow and come back on Wednesday and come back on Thursday. I'll pay you something for it today, and then I'll take that risk. That's what a speculator does. And you know what? If the miller shows up on Tuesday, good for the speculator. But if the miller doesn't show up to the week later or doesn't show up at all, that speculator took real risk. And there should be compensation for the speculator for doing that. And interestingly, as we wrote our response, we actually wanted to point out that this notion of speculation actually grew up in Italy. It grew up in the port of Venice, where traders would show up, and if there was a ship to load their cargo on, they would load it up. But if they didn't, at first they sat there and waited week after week, because back in the old days of Mediterranean sailing, you couldn't be sure when the ship would arrive, and there was no means of communication to know where it was out in the Mediterranean. So speculators showed up on the quay in Venice and would say, you know what, we'll buy your product and we'll take the risk the ship shows up. That's where the notion of the first banks arrived. And that's where the notion of speculation really we see it historically. Anyway, speculation is essential for markets to operate as they do in modern economies. Now finally I want to come to the last point where we really tried to make our argument to the Vatican. The Vatican pointed out that in some parts of the market, and this is the area of credit default swaps, and an area known as naked credit default swaps, and that is, should someone that doesn't actually own a bond, doesn't own a debt instrument, be able to take a view as to the creditworthiness of a lender if they actually don't hold that lender's debt? So somebody else holds that lender. A lender, Key Bank, has issued debt securities. They're out in the marketplace, and they're trading at a certain premium. And someone who doesn't own those bonds, whether they should be able to buy credit default protection or sell it on the risk of failure of Key Bank. There are a number of commentators who said this is an impermissible use. It's like owning fire insurance on your neighbor's house. You don't have a risk of loss. Should you therefore be able to own fire insurance on your neighbor's house? Well, one of the distinctions between derivative markets and insurance markets is you don't need an insurable interest in derivative markets in order to participate in these markets. It's one of the main distinctions. It's one of the reasons why there's a secondary market in derivatives. There's not a secondary market in insurance. Because you buy a policy, you can only hold that policy so long as you have an insurable interest. There is really no secondary sale. You can't buy auto insurance and then sell it to somebody else because you don't think you need that policy or that much policy. Derivatives have a healthy secondary market. They have these speculators that may or may not. If in derivatives, it was only the people who had risk, everybody would be one way. All the farmers would only want to be protected. They wouldn't want to buy the other side of that trade, which is why in derivatives, we allow people with non-insurable interests to buy and sell derivatives in order to have a vibrant market. And so the point we made in our response to the Vatican was there's actually legitimate reasons for people that don't have insurable interest. And one of the areas that the Vatican specifically objected to was sovereign credit default swaps. That is, the ability to take the view that any government is not creditworthy, or at least to the creditworthy standards that they've been rated, and therefore to hold an interest that they would actually not be able to satisfy their debt obligations. Now remember I said that credit default swaps also, all derivatives provide a pricing function? Well, if there was no way to short a government's creditworthiness, then there would really be no way to know the true creditworthiness of a government. And guess what? Those governments would actually have to pay more to borrow because of the uncertainty as to whether they're actually worthy of the government. So it actually serves the utility of governments to have credit default swaps written on their creditworthiness. And worse, better, it brings a discipline to markets. Because we all know that not all governments are frugal. Some are quite spendthrift. Well, if there's no way for people to take a view as to their creditworthiness, just as if there's no way for people to take a view of the creditworthiness of an issuer, there wouldn't be a discipline on them. And the pricing function of derivatives means that firms that are spendthrift, governments that are spendthrift, will pay an appropriate price for their lack of frugality. And governments that are frugal will also pay an appropriate price to borrow and lend as well. And that's why it's our view, and I think it's the view of most economists, that there's a legitimacy to being able to buy an interest on the potential failure of another, whether that be a government or a corporate.
That is a fantastic and clear explanation. Thank you. I suspect there are several persons in the audience who are hearing about this question about credit default swaps for the first time who want to look into it some more. But we need to move on in the interest of our time. And here's a question I have for you. What kind of attention did your reply to the Bollettino receive? How would you characterize the responses?
So there were a lot of really fun responses. A lot of quiet high fives. My parish priest was delighted to be interviewed by the Wall Street Journal. He checked with his bishop first to find out whether he could speak to the reporter, and that was fun. We got a lovely note from the U.S. State Department. So a German newspaper, the Süddeutsche Zeitung, did an editorial on it and noted that that the response opened a remarkable dialogue with the Vatican that constituted a nice piece of contemporary history. And I was really, sometimes we think about Europe as really moved way beyond its Catholic roots. And yet in the European regulatory community, I can't tell you how many senior market regulators actually reached out with congratulations, commendations, read both the bulletin and the letter with great interest. And we did hear through the Italian regulator that they were looking to arrange a meeting between us at the CFTC and the authors of the Bollettino, and then the Italian government changed, and as did the regulator. So we're waiting to see whether that gets scheduled. But we haven't heard back officially from the Vatican, and I would love to be able to have the dialogue with them directly to see what further questions they have on our response, to talk about these things further, and to know...
Are you taking initiatives to do that? Do you have friends in the Vatican who might help you do that?
I don't.
Well, we might have some.
Well, we're delighted to follow up on that.
So last question, and then we'll have time for a few from the floor. How would you characterize generally, how would you describe the relationship between your faith and the ethical implications of your faith and your professional work in finance throughout your career?
Yeah. So I think, first of all, any human in life, in any walk of life, whether it's finance, politics, medicine, engineering, business, anywhere, I think has a challenge because we're all fallible human beings of living their faith and living their faith in their professional work. I think there are unique characteristics of that, though, that each profession brings to it. And so I spent 16 years practicing law and 14 years in the financial markets, and both the legal profession and the financial profession bring unique challenges to living a life of faith. In the finance world, it's an amazingly almost binary world in financial markets. There's a scorecard. It's called the P&L. And every trading desk today operates on a P&L. And basically every year, you know, they're either profitable or unprofitable. And if they're profitable, it's mathematically measured. And their reward system is really very binary. You know, if you make this, if your desk made this much, you're paid this much. And so in that world, when there's misbehavior, it's usually it's cheating on the grade report. You know, if you're in the world of compliance, where desks are getting in trouble, it's where they're not making their numbers, and they'll usually try to manipulate something to make the numbers. There's a really excellent, I don't have the name of it to hand, but there's an excellent study that was just done by an Anglo-American trade association that analyzed all financial crime since 1790 to date. And what they were able to do was basically take all financial crime and put it in 20 buckets. That just, it's the same stuff all the time, year after year. It's just in different forms. But it's fraud, it's market manipulation, it's manipulating the numbers. So finance, I think, misconduct, it's fairly definable, fairly understandable. I've now spent almost 5 years in the political world, and there's no scorecard. I guess you could call elections a scorecard of success in the political world. And where there's cheating, it's usually to depict the other person as failed and having engaged in misconduct in order to better oneself. Where in the financial world, you're trying to improve yourself by cheating on your marks. In the political world, it seems like every election season, you're trying to paint the other person as despicable, as a home wrecker, as a you know, whatever it is, in order to raise yourself up. So it's an interesting world. So to live a moral life, whatever your profession is, I find you need to find out where the temptations are and where the fallibility is. Where are the traps? Where are the pitfalls? Where are those deadly sins of human life, whether it be greed, avarice, pride? What are the traps that are going to lead you into? In finance, if it's greed, it's usually going to be cheating on your report card. If it's in politics, it's going to be doing horrible things to your opponent in order to raise yourself up, to keep yourself in power. And so I think that the practical goal in whatever you choose to do in life is look at the patterns that have snared those that have come before you, and look at your own failings, look at your own tendencies, look at your own temptations, and understand them vis-a-vis those traps. And then on the positive side, live for the good of others. Live in any environment that you're in. Say, how can I make this a better place? How can I help the people around me get to the right place? How can we raise the human dimension of what we're in and raise our game in order to live our faith?
I would love to have a copy of that study.
We'll get it for you.
We're putting together a portfolio of cases which display Catholic social thought, and to use that study for headings of cases, that would be very valuable.
I keep turning to Mike. Let me just say, Mike, my chief of staff, is also a graduate of Catholic law at the law school here at Catholic University, and has been a great friend and great helper to me. And Mike, do you remember the name of that study?
Okay, fantastic. Well, we have about 5 minutes for questions from the floor. Professor Torres.
Mr. Chairman, thank you very much for your response to the Bolletino, and thank you very much especially for the respectful tone of it, and just the spirit of dialogue in which you responded to the Bolletino. At the very end of your response, you acknowledge that there are some areas that are problematic, but of course the response was very trenchant in that the vast majority of what you do in those 3 points you just outlined, they're very moral uses of derivatives and credit default swap. But again, at the end, you did mention that there are areas that are problematic, but you didn't elaborate on that. Would you like to take a moment? Where do you see problems in this area?
Yeah, so there's unquestionably not all right in these markets. There are unscrupulous sales tactics. There are, taking advantage of one's superior knowledge is appropriate, that mechanics situation. But duping people that are less sophisticated in unscrupulous ways is not acceptable. And there are way too many instances of products that are either unnecessary or way more sophisticated than necessary or inappropriate for users of those products that are being sold in the markets, and that are inappropriate. There was far too much. In that area that I talked about of cheating on the report card. Sometimes the most dangerous markets are markets that are very stable, because in the lack of volatility, you have trading desks looking to goose up their numbers and get into areas of the market and trading strategies that are inappropriate. So regulation exists because there are bad practices in the markets, and I very much believe that markets, in order to be successful, must be well regulated, which brings me to the point of it's the regulator's job to make sure that markets don't feed on themselves and cannibalize themselves. And we saw an instance that we mentioned in our letter of a new practice that was starting to emerge called manufactured credit events. And that's where people that the subject of credit default protection. They were a lender that if they failed in a debt payment, those who held protection on it would benefit from. And people were approaching those lenders saying, I know you've got money to pay your debts when it's due, but your interest rate is X. If you default voluntarily, we will benefit because we are on the other side of that trade. We'll take some of the money we make and pay you in order to refinance at a lower rate of interest. That's known as a manufactured credit event or a narrowly tailored, but we looked at that and we knew that this was starting to develop in the market. And we said, that's the type of thing that destroys the entire marketplace. It's sort of a corner of the market that starts feeding on itself and destroying the integrity of the market itself. Now, in many cases, regulators would see something like this and let it happen, and then once it happened, send in the enforcement people, sue them, and then 4 years later, when it finally works its way through the court system, a big judgment, and the regulator would tack a scalp on their whatever you tack a scalp onto their war belt, and claim victory. We want to take a different approach, and that was. Our focus is on the integrity of the market, not scalps on the belt. Our focus is on not letting it happen, as opposed to letting it happen and then go after it. So we both, in private communications, but also in some public statements, let it be known that we took a very dim view of that market practice and reached out to the Industry Trade Association that sets a lot of the terms of the standard contracts, that we expected them to take action to make this type of activity impermissible. And as a result, there's now, that deal was called off. A few other deals that were like it were called off. And the Industry Trade Association has formed a working group that is now working to amend language in the standard contracts to make these type of transactions impermissible. So what have we achieved? We've achieved the end to a practice that might have destroyed the integrity of the market. We've done it in a way that avoided litigation, and the market remains healthy. So vigilant regulatory work doesn't always have to be about big flamboyant enforcement action. It can be just careful attention to markets, conversations both private and public, letting the marketplace know what the regulator's expectations are, and the regulator's not afraid to use the tools of enforcement if need to be, but that the market, physician heal thyself, marketplace, heal yourself before you go in a direction that's not healthy to markets. And so we think part of our role as market regulators is to bring that level of intelligence and market understanding to bear in a proactive way. And we're not afraid to take enforcement action if we need to, and will and always will, but against those 20 bad practices, which will be there for another 200 years. But also, if we can get ahead of it, we try to get ahead of it as well. And in the Vatican, we pointed this out in our letter to the Vatican. And the Vatican, believe me, the Vatican got a lot right in the letter. But some of these market understandings we wanted to take our opportunity to correct.
So you held the stick of compliance, but when you were speaking with the industry itself, were you appealing to self-interest or conscience primarily?
Well, I think there's always a little bit of both. In human nature, there's always a little bit of both. Yeah.
We have time for one brief question, and then that would have to be the last one in the back.
Mr. Chairman, thank you for your talk. Can you talk a little bit about short selling?
Sure.
Something that's always immoral, or are there situations where it's good?
Well, short selling, I think, is akin to naked credit default swaps. So short selling is a way of expressing a view that the value of something is not commensurate with its underlying value. The market value, in short selling would be the case, you think the market value is higher than the intrinsic value. But how could you express it if you don't own a share in that company? So let's say you open the paper one day and say, Tesla is worth that much? That's ridiculous. The cars, I just owned one. It wouldn't start. It was on fire. It's not worth the market. And I don't mean to pick out Tesla. How can you express that view if you don't own the stock? And if you own the stock, all you can do is sell it. But you're going to sell it at that price you think is too high. So I don't believe that short selling is an immoral practice. I think it's a healthy practice. What does it do? It helpfully brings the market into balance. So those who think it's too high can short sell. Those who think it's too low can buy. And you bring the market into balance. And so we have time for one more anecdote. Bitcoin futures. I'm sure nobody here is spending time thinking about Bitcoin, right? For a year, it dominated my life, Bitcoin. And this is another case of being proactive. In 2017, so let me back up for a second. One of the big claims that come out of the financial crisis is, where were the regulators? Why didn't the regulators get ahead of this bubble in these securitizations of mortgage loans and others? The next time around, regulators have to get ahead of bubbles. And that's why the federal government formed something called the Financial Stability Oversight Council, which is a council of all the major financial regulators here in the United States. That's why the Financial Stability Board was formed by the G20. The idea was regulators would get ahead of bubbles. Well, here's a story that hasn't been told. We did it. The Bitcoin bubble was blowing up in 2017. In the summer of 2017, it was a few $1,000s. By December of 2017, it was at $19,000. It was at $19,050 the day the CFTC allowed the self-certification of Bitcoin futures on the Chicago Mercantile Exchange. And since then, since there's been the ability to short the price of Bitcoin, Bitcoin has come into balance and bubble averted. Now, the value of Bitcoin is for market participants to decide, but for those who do not believe it was worth $19,000, the first opportunity to make that view was when the Bitcoin future came into being in December. And as a result, the Bitcoin price now has price opposition. When the bubble was going up in the second half of 2019, there was no way of saying, $14,000, that's ridiculous. $15,000, that's ridiculous. $16,000, that's ridiculous. And up it went. It was only when the future was launched can those who said this is a ridiculous price, I'm not saying they're right or wrong, was the first chance they had to express that view and bring Bitcoin. And so bubble averted. Now, where Bitcoin goes from that will be a fascinating thing to see, but at least that bubble was averted because of the ability to short the value of Bitcoin, which is only available through the derivative market, the launch of Bitcoin futures.
Thank you. Chairman Giancarlo, I think I speak on behalf of many when I say thank you so much for being a paradigm in so many ways of what we're trying to do here. And I hope you'll return again to our campus soon.
It'll be my pleasure. Thank you. Thank you.